All right, it's 9 o'clock, so let's get started. So we won't have sessions next week. Next several weeks, you'll just watch the videos. But what we want to do tonight is I want to walk you through paper 1, which is all you really have to work on in this class for the next 2 or 3 weeks. We don't have an exam for a while. The first paper, it's a pretty good, challenging paper, so spending your entire time on it for this class would not be time badly spent. It's actually, they're really good articles, and it really does introduce you to the industry. Any questions on the class itself before we get into paper 1? Any issues anyone's having? I don't know if anyone started watching the class videos. Hopefully they're working well. I'll put this video out there as well tonight. All right, so let me share my screen, and let's start with the rubric for the paper. So you have this for the paper, for paper 1. So you can see it's lined up, article 1, 2, 3, 4, all the way down, and the percent each is worth. So it's very, very straightforward. I'll talk some where students tend to lose a lot of points on this paper. So Article 1 is the longest, and it may be the most difficult of them. So we'll walk through the article a little bit tonight and show you what we're looking for. What I recommend that you do in Article 1 is you read the introduction, the abstract, and then you read the conclusion. Figure out what these authors are talking about, and we'll do a little bit of that tonight just to let you know what it is we're looking for here. I looked up the term human capital. I Googled some of it this week, and this article is about the only thing that comes up related to life insurance. So it's still, as old as the article is, it's still the only article out there. They talked in this article about, in fact, right here on line 11, they talk about more research being needed. So they somewhat implied they'd be doing a follow-up article, but they never have. There's just not anything out there. And Dr. Ibbotson, who wrote the article, or one of the writers, he's retired, so he's probably not working on this at all. So we'll walk through that one. Article 2 is only 2 things, and what Article 2 does is takes what they've already done in Article 1 and brings in a couple of really specialized issues related to optionality and to age, which are really critically important, but weren't covered very well in the first article. So it's only a 1-page article. It's really short. And so then you finish that. So what I recommend is you start with 1 and 2. Don't even read 3 and 4. Read articles 1 and 2 together and look at the rubric as you're reading. So the purpose of Article 1 is to talk about how human capital relates to asset allocation and life insurance. And then they have these things that influence that. So magnitude, volatility, correlation, mortality, risk tolerance, wealth, bequest motive. And then the other article brings in optionality and age. So the article is talking about how can we use human capital to bring these 2 things together, and then they list the factors. So that's the way your paper is going to be written. You want to set up what they're trying to accomplish and then go through the factors and what each of these factors, what does correlation imply for, with correlation of human capital imply for life insurance and investing. All right, so it's very clear and you really, when you do your summary of these 2 articles, there's really no reason to break your discussion between Article 1 and 2. I would write it for Article 1 and then come back and bring Article 2 into the spot where it belongs, or add it as another factor. So, sorry, I'm letting people into the classroom here. All right, and then you get the 3 and 4. 3 and 4 are related, and there is some overlap between 3 and 4. Article 3 talks why people aren't buying annuities. Article 4 talks about that as well, but gives other factors. So there's a lot of these extra factors in there. You'll have to find these, identify them. Some of them are very, very easy to discuss. Some of them are a little more difficult. What people really mess up on Article 3 is this line 19. I have trouble getting students to talk about the biases that cause these. And so what I did is I gave you an extra article. It's a summary of the biases. So essentially I took the biases they list here and I gave you an extra Word document to help you get through those biases so you can understand them better, because some students were just leaving those out entirely. Your paper could follow this in exactly this order if you like. A lot of students do that. You don't have to, but I would recommend that you do it in a way so you can very easily go back and check and make sure you don't have anything left out. All right. So coverage is covering all of these things. That's 40% of the paper. Clarity and organization is how clearly you write, how well organized the paper is. And in critical thinking is bringing in your own ideas, what I think is most important here, or what I thought was interesting here, or I wonder if they thought about this, or I disagree with them on that, those critical thinking kind of things. So that's how you want to structure this. So this rubric is out there. You want to definitely have this rubric printed out, or at least next to you while you're reading the articles, so you can see how they fit in. And we'll look through the articles so you can see. The next thing I want to show you, y'all let me know if you have questions as you go. It's probably better just to unmute and ask them than to use the chat function. So if you go into the class notes, these are out on Blackboard, and you can just search on human capital and life insurance. It's on page 9. There's 2 outlines of the articles. The first is somewhat of a high-level outline of the 4 articles, and then the next one is a much more detailed outline. I'm not going to cover this more detailed outline. That's there just to help you see if you've missed some things. It gives you some really good quotes from the articles to help you. So I'm going to skip the more detailed outline, and I want to focus tonight on the high-level outline, so that you can before you start reading. It's really, really important before you jump into these articles, because they can be a little bit complex. Know exactly what we're after when what we're looking for. So let me introduce you to this Article 1. So let me let you see what Article 1 looks like. So here's Article 1. It's written by Peng Chen and Robert Ibbotson. I don't know these other 2 people. I've met these 2 gentlemen. Ibbotson's the most famous of the 4. He has a whole company named after him. He's retired, and Chen took over his company, and then I think Morgan Stanley or someone bought out his company. So this is an impressive. These 2 are impressive. These 2 are probably impressive as well. I just don't know them at all. So you notice that there's an abstract at the beginning. I would read that, and then I would jump to the very, very end of the whole thing and read the conclusion. You can skip the appendices if you like. I'm not really that interested in the appendices. If you want to read through them, that's fine. But go to the final conclusion and read that. So read the abstract first, and then read the conclusion. So let's look at the abstract, because it right there tells us exactly what this article is about. So whenever you read an article like this, finance is very theoretical. So they're trying to prove a theory, a belief that they have. And so they establish that up right up front. You want to make it really clear in your paper exactly what is it that they're trying to prove. And then you're going to go through their proof. You can go through the different pieces that they talked about where they try to prove that their model actually is correct. Let me start off by showing you their model. So their model is at the bottom of page, well, 99 of their numbering, but the bottom of page, whatever page number it is, page 3. All right, you probably want to have this, or you do want to have this formula in your paper. So let's just talk about this formula. It looks complicated, but it really is not at all. So this is what this thing right here is exactly what this article is about. All right. So they want to maximize. Anybody want to guess what E means? Have y'all seen formulas like this before? So E is the expected value of what? So we've got D, we've got Q, we got U, we got W, and we got H. All right, so let's start with H. H is human capital. You notice H is in the 1 minus Q, but H is not in the Q. So what does Q stand for? We're going to be using Q a lot later in the class when we do mortality tables. But Q is your mortality. It's your probability of dying. So what would 1 minus Q be? Well, 1 minus Q is your probability of living. So you have your alive state and your dead state. Anybody know what U stands for? Any economists out there? U alive, U dead, what does that stand for? U, boy, I wish we were live here so I could get y'all to talk some. Everybody's probably talked out by now, but U stands for utility. You can think of that as happiness, satisfaction with life. So what this model is trying to do is to maximize the expected value of your alive state and your dead state. Now do you see why human capital is not in the dead state? What is human capital? Human capital is the present value of your future earnings. Well, if you're dead, the present value of your future earnings is 0. There is nothing. And what is wealth? W is your wealth. And then this thing right here, I don't know why they use this symbol, but this is your life insurance. And then D is your bequest motive, how much you want to leave to your heirs. So if you're alive, you don't have the bequest. If you're dead, you do have a bequest. So what we're trying to do, and this gets all the factors that we're talking about here. How strongly do you want to leave stuff for your heirs? How strongly do you think that your chance of dying is high or low? What's the wealth effect? What's the life insurance? We're trying to bring all these together. So what they're trying to do is find a model that maximizes your wealth, which is your investment portfolio, your life insurance, and your human capital, bringing all that together so you're as happy as you can be whether you're dead or alive. All right, you can see why this formula is so critical because it really drives the entire paper. Any questions on that? Hopefully y'all are seeing what we're talking about here. Some of y'all might have already read the paper or pieces of it. Is that making sense? I can't tell if y'all are with me or not, so I'll go ahead. We need to have a spokesperson for the class that says, "We got it, Professor, keep going," but I'll just assume you've got it. So let's look at this. Got it? Good. All right, thanks, Franklin. All right, so let's look at this abstract. Extremely important that you understand this. I do count off a lot if you miss the main point of the article. So they say some stuff here that I actually don't agree with, but I'll tell you my view of what they say that the industry is actually doing. But they're talking about financial planners and advisors. These are people to give you recommendations on asset allocation. Should you buy stocks or should you buy bonds? They give you recommendations on insurance. So they increasingly recognize that human capital must be taken into account when building optimal portfolios for investors. I actually don't think that's true. I've asked some financial planners and advisors how much do they use human capital to influence their recommendations, and I haven't gotten many of them to say they use it that much. He says they say increasingly recognize, so maybe it's gone from 1% to 2%, who knows. But human capital, now can you think of human capital as an asset? So you have stocks, you have bonds, you have your house, so that's real estate. You may have some cash, maybe you have some artwork, but you have another asset called human capital. So that's an asset. But it's not like other assets. One of the issues with human capital, and this is what I got out of that class that I listened to this summer, it's a very illiquid asset class. It's the present value of your future earnings. Very illiquid asset class. So you can't really sell it, although there are people doing some things we'll talk about later in class actually selling their human capital to pay for college. But it's hard. It's hard to use as collateral, so it really makes it different than other asset classes. But it is an asset. But it includes a very unusual risk called mortality risk. It's an asset that goes to zero as soon as you die. That's not true about your stocks and bonds in your house. If you were to die tomorrow, your estate could sell all of that and get money out of it. But once you die, your human capital goes to zero. life insurance, and you definitely want to talk about this, life insurance is a perfect hedge to human capital. So if your human capital is $500,000 and you buy a $500,000 life insurance policy, if you live and keep living, you make the $500,000 by earning your salary. If you die, you get $500,000 of life insurance. It's the perfect hedge. And here's a key phrase right here. Human capital affects both the asset allocation and how much life insurance you need. That is absolutely critical. What they say they want to do is create a model using human capital to link asset allocation and life insurance. So they want to use human capital as that link between these two decisions. What are the two decisions? Make sure you have this in your notes. It's really critical. Your two decisions are related to your asset allocation and how much life insurance to buy. We do not have a human decision about a decision about human capital. We're not trying to decide how much human capital you should have or need. We're taking human capital as a given, and we're going to let that drive our asset allocation and how much life insurance to buy. All right? They say historically, asset allocation and life insurance decisions have been made separately. I agree with that. That is true. So they're trying, there's a key phrase right there, a unified framework. And I just showed it to you on page 3. That unified framework was that formula where human capital is really what drives this. And so we'll get into that. All right, so you see what they're after. So you have to try to figure out, how does human capital relate to asset allocation? How does human capital relate to demand for life insurance? And how can we help it, or how can we use it so we make a better decision? That's what the word optimal means. So we maximize our utility whether we're dead or alive. Okay, so that sounds like a really tall order in this paper. So let me go back to the class notes. Any questions up to there? So Article 1, they want to make asset allocation decisions and insurance decisions jointly. Why? By looking at, and this is a absolutely key phrase, they want to look at the magnitude of human capital, the volatility of human capital, and the correlation of human capital, and how that is going to affect asset allocation and life insurance. All right? So there's 3 things right there. So there's several factors here we're going to look at. The first factor is the magnitude. The second is volatility. The third is correlation. The next one is your probability of death. The next one is risk tolerance. The next one is wealth. The next one is bequest motive. The next one is optionality. And then the last one that I don't have in here is age. I should put age in here. That somewhat relates to magnitude. All right. So, but this is the key phrase, because magnitude, volatility, and correlation have a huge impact on your decision about asset allocation and life insurance. Now, you might think, what influences the magnitude of human capital? Well, you're doing it right now. You're going to college. College should increase your human capital. The class I listened to this summer, it was pretty interesting. They were talking about whether or not parents care about their kids. Really quite interesting. There's some parents that are altruistic and they really want their kids to advance and do well in life, and so they invest a lot into their children's human capital. And there's some parents that just don't care and they spend all their money on themselves. So he was talking about other factors. But those are factors that influence human capital. What we're going to do is take that as a given. We know what the magnitude is. So people with good education will have more human capital. Volatility. All right, so this is a key that you need to get early on in this article. A lot of students miss this. If you miss this, it really makes the article difficult. So let me just tell you right now, human capital equals the present value of future earnings. And the key there is there's a discount rate, right? Anytime you get the present value of something, you have a discount rate. What do discount rates, where did they come from? They're a function of risk, right? What is risk a function of? Risk is a function of volatility and correlation. You already know this from your finance classes, or even, I think even the actuaries, you probably have studied this. What discount rate do you use for an asset that's very volatile? So you have a stock that's extremely volatile, has a lot of debt, you're going to use a higher discount rate. So volatility increases the discount rates. So human capital, jobs that are very volatile. So you might make $500,000 one year, you might make zero the next, and then you make $600,000 the next, and then nothing the next. You have these big bonuses, and your bonuses do well when markets are doing well. Who knows? But you have a very volatile income. So I like to use an example is, let's say someone working for Men's Warehouse. Men's Warehouse, man, their earnings are very commission based. Right now we have COVID-19, no one's shopping. Boy, they're losing a lot of income. Or we have a recession, people aren't buying clothes for work. So their commissions are down. It's very volatile. So that's volatility. What does correlation do? Well, hopefully you've seen the capital asset pricing model. Those assets that are highly correlated to the economy, they have higher discount rates than those assets that are lower. Hopefully you remember the term beta. Remember, high beta companies have high discount rates because they're more sensitive to the economy, and low beta companies have lower discount rates because they're less susceptible to the economy. They're not tied. All right, so there are jobs, there's human capital jobs that are more highly correlated to the economy. So Men's Warehouse, if I was working as a salesperson at Men's Warehouse, I would have a very high beta for my discount rate for my human capital, and that would reduce my human capital because Men's Warehouse is very sensitive, very closely tied to the economy. People just don't buy, well, they don't buy suits anymore at all, but they definitely don't buy business casual as much as they used to. But even now, when the economy weakens, and there's people who haven't gotten out of their pajamas since March. You know, it's just, they're not buying clothes as much, so they're very sensitive to the economy. So that's real key to this. So human capital is an asset that has volatility, and it has correlation just like stocks and bonds do. All right. I'm hoping you are getting that before you read the article, because you'll miss a lot of the article if you don't catch that piece of it. Any questions on that? Now, does that make sense? Let's talk about it. So you're a Supreme Court judge. You have a very high income, extremely low volatility. The only ways your income goes to zero is if they impeach you. I don't know how many Supreme Court justices have been impeached. I think there's been at least one, but not very many. Your correlation is zero. You're going to keep getting paid no matter what happens to the economy. So you have very low volatility, very low correlation, very high income. A Supreme Court judge would have, you know, I don't know how many years they're going to work, but they're going to, you know, if they get in there at 50, they might work 30 years. They're going to have a very high human capital because of the high pay. Then you take, let's take someone who's a stock analyst, a stockbroker. So the high income, but extremely volatile, losing their job, you know, the economy goes in the tank. Big investment firms, they lay off a lot of people, and they lay off a lot of people when the economy is bad. So the volatility is high and the correlation is high. That means a stock analyst working for a big investment firm their human capital is going to be greatly harmed because of the high volatility and the high correlation. Now, you might not like the implications of that, but you're going to see that means a Supreme Court judge should buy a lot of life insurance, but that stock analyst doesn't need as much life insurance because we're going to use a high discount rate for their human capital. And so that's how magnitude is really driven by your education, your training, but it's the present value of that is going to be driven by volatility and correlation. All right. So think of human capital just like an asset, and you have the objective function. We're trying to maximize that objective function using human capital as the link between asset allocation and life insurance. Article 2 brings in another factor of options, and I I really should have put this in, add this to your list, and that's age. We'll talk about age. Age is in the rubric. But Article 2 does a good job to talk about, and I want this really clearly stated. I've had several students lose points on this. Why do young people buy more stocks than older people? And I'll tell you right now, just so you'll hear it twice, because financial planners say it wrong, at least the way we talk about it theoretically in finance. You have a lot of financial planners say young people buy more in stocks because they can diversify over time. They call it time diversification. There is no such thing as time diversification. Stocks do not become less risky with your horizon. They actually become more risky with your horizon. So it has to do with age, and it has to do with human capital. And so the reason young people, and it might even be in my notes, so let me look down so I don't, no, I didn't tell you. So I don't have it in my high level outline. But just to make sure you have this before you read that second article. Young people, because human capital is their largest asset, and human capital for most people looks more like a bond than like a stock. Most people have fairly predictable income year after year. Even, I worked at UTSA in the investment side. I never really feared losing my job, even with the economy tanked. I felt fairly safe. Human capital is more bond-like. So when you're 20-something, your biggest asset is human capital, and it looks a lot like a bond. Well, if your biggest asset is a bond, that gives you the freedom to allocate a lot of your other investments to stocks. As you age, what's happening in human capital is getting smaller. So that bond component of your assets is getting smaller and smaller as you age because your human capital is shrinking. So then you need to reduce your stock allocation and put more of your money in the bonds. And that's where optionality comes in too. So really understand that they talk about in the second article, not only does your human capital decline over time, but your options with human capital also decline. As you get into your 30s and 40s, changing careers gets really difficult. And so they're also going to recommend that as you get older, you need to increase the optionality of your investment portfolio. Now, I actually disagree with them on that. Let me just tell you now, when they talk about optionality, they're talking about active management. When you're young, you should be a passive investor and go to Vanguard. As you get older, you should use active management because that gives you more options. I absolutely disagree with that. What I argue, and those that took my risk management class will remember this, I argue that as you get older, you should actually use real life options, stock options, index options in your portfolio to protect you. So you should, as you lose the option of changing careers, you should add options of stock options. So I disagree with the article and what they imply by the optionality, but I definitely agree with that. They're also going to say that certain jobs have more optionality just built into them. So I've talked some about this with actuaries versus finance. In class, I would ask you this question and we'd have a discussion about it. It's a little tough to do it at 9:30 online. But actuaries have much more optionality than finance. The guy who took my place at UTSA, I was head of equities. So I was portfolio manager. The guy who took my place was a life insurance actuary. So he switched from actuarial science to investing. There is no way at his age I could have switched from investing to actuarial science. It would have been impossible. Actuarial science can also very easily switch to decision science. In fact, I think decision science taking over the world. I think I'm seeing more and more actuaries getting out of actuarial science and moving, and they just move over. There's almost no training needed. Everything actuary works extremely well moving over.
No, it's not.
Is that a question? All right. So you actuary majors, you picked a good degree. It really is an amazing degree. I could go back to school and try to get all the math to do actual, but I'm getting too old and too lazy to do that now. I had thought about becoming an actuary early in my career, and I just didn't get into it. Once I got to a certain age, I really needed to delve into finance, and going back to actuary would have been too much of a detour. So what that means is actuaries' discount rate will be much lower because they have that flexibility. It gives them more options. Their career is going to look more like a bond. They can definitely put more into stocks. But as they age, that optionality will decline, but their optionality declines more for finance majors than it does for actuary majors. So that's a key part of Article 2. It's only one page. A lot of students completely miss that part of it because it's only one page. So what you need to get out of these articles are these inputs and understand them. And what they do in the article is they go through case studies. How does correlation affect stocks and bonds? So if you have a career that's, and this is a good example, correlation. You have a career that's highly correlated to the economy. When the economy tanks, you do badly. Your income drops. When the economy is doing well, you do really well. What does that imply? That implies you should have a lower allocation to stocks and a higher allocation to bonds. And the part that students really struggle with, because your correlation is high to the economy, your discount rate is high, which means the present value of your human capital will be lower, which means you need less life insurance. That just seems crazy, doesn't it? But that means a stock analyst working on Wall Street who has very volatile income that's highly correlated to the overall stock market, they will buy less in stocks and more in bonds in their portfolio because their human capital is more stock-like, and they'll have less of a need for life insurance because the present value of their human capital is lower because their discount rate is higher. I hope y'all understand. Anybody want to repeat that? Did y'all understand it enough that you could say that back? Do you want me to say it again? It's a really critical.
Yes,
please. So let me say it again. So let me type it this time so you can see it. So let's take a stock analyst. What can we say about a stock analyst? High volatility. High volatility of what? Of human capital. All right, that's what we're talking about here. High correlation. Correlation of what to what? Of human capital to the economy. If you need that stated another way, you can say their human capital has a high beta. All right? So what does that mean? That means your human capital is more stock-like than bond-like. Heavy human capital looks more like stocks. Therefore, they should allocate more to bonds and less to stocks than, say, a Supreme Court justice. Why? Because they already have a lot in stocks. That's their human capital. Their human capital looks like a stock investment. The other thing it implies is the discount rate for determining their human capital. Remember, human capital is the present value of your future earnings. Will be very high, reducing your human capital, right? A higher discount rate gives you lower human capital, thus reducing your need for life insurance. All right? This is what the article is saying, and I know that way. It seems like so, it seems convoluted. Some people say, are you telling me a stock analyst who knows all about stocks, that's what they do for a living? You're saying they should underallocate their portfolio to stocks, and that's exactly what this model is saying. And other students say, why would the fact that they're a stock analyst mean that they need less life insurance? Well, because they have a volatile income that's highly correlated to the economy, their discount rate is higher, thus your human capital will be lower. Remember, human capital is perfectly hedged by life insurance. So the more human capital you have, the more life insurance you need. All right, so you see how this article is trying to link all these things together to give you an optimum life. So if you're a stock analyst, they'll say the best life you can have, stock analyst, is to buy more in bonds and to buy less life insurance. You don't need as much life insurance. To me, that's not intuitive. You can read the case study where they go through that. but that's what their model says. If you disagree with it, then you need to step back and figure out what part of the model do you disagree with.
If your life is more volatile, wouldn't you, I mean, if you have good times and bad times, when you're having a bad time, there's more likeliness of you to die. So wouldn't you want life insurance?
You can talk about that, and I'll give you critical thinking points for that. They do not address any correlation between the volatility of human capital and the probability of death. I mean, that's a good point. Definitely, we know, certain, stress, or even people just taking their own lives. There's things that certainly could be there, that there's more to the human experience than what they're talking about. This was their first go through, so definitely bring that into your paper. That's a really good point, but they don't address that at all. They don't talk about any correlation between that. Now, they're not talking about dangerous jobs. So if you have a dangerous job, they do cover that. That's part of their mortality, but that's more of a constant. Your probability of dying is a constant. They don't talk about your mortality changing based on where you are in the economic cycle. So definitely people with more dangerous jobs, that they're more likely to die young. Yeah, they need more. Their need for life insurance is higher. So you may not agree with all this article, and you can definitely disagree with it, or say you don't see what they're saying. But I want to make sure you understand the points that they're making. And definitely with the question you just asked, you're definitely understanding it. So that's good. You're showing good comprehension. I don't know if you've read the article already or not, but you're definitely catching on to what they're after here. Now, some of them are very straightforward. Subjective probability of death. They're going to argue that doesn't influence your stock versus bond allocation, but definitely influences your life insurance. Risk tolerance. They're going to argue that definitely influences your stock bond allocation, but doesn't influence your need for life insurance. Again, you could disagree with that. You might say people with low risk tolerance should buy more life insurance. Who knows? Your wealth. They're going to argue that people with high wealth should have less than stocks because they've got wealth they need protected. And so if they have a lot of wealth, so wealth versus your human capital. So when you start off your career, you have almost no wealth and almost all human capital. And there you put a lot in stocks because your human capital is like a bond. But as you accumulate wealth and it gets larger and larger, then you want to move down on the stock allocation, just because you don't want to lose so much of that wealth that you built up all at one time. But wealth can also influence life insurance, because obviously if you have $3 million in wealth or $100 million in wealth or whatever, you may not need life insurance at all, because you can cover that. You can cover those needs for your beneficiaries through your wealth. The bequest motive is pretty obvious. They're going to argue the bequest motive. That's your desire to leave money to your heirs. That motive has no influence on your asset allocation, how much you have in stocks and bonds. You might debate that. I could think of an argument on that, but they say there's no influence. But it obviously influences your need for life insurance. If you need to leave $1 million for your heirs, but you only have $200,000 saved up, then you need to buy $800,000 of life insurance. And then the optionality is in there as well. I think I covered the age somewhat in talking about the volatility and the correlation, and whether, for young people, if your human capital is more like a bond, then you can allocate more of the stock. So I kind of have it in there. But the optionality is there. The more optionality you have, the more you can allocate the stocks, the more life insurance you need, because your discount rate is lower. And then they say these can all change over time. So this is not a model where you just look at it once. And in fact, they even mentioned that the type of life insurance they used was annual renewable term. And they mentioned, down here, that more research was needed, that maybe they should try other types of insurance, and maybe they should try other models of utility. It was interesting to me listening to this class this summer on human capital. He had a model that was very, very similar to this. And he actually brought up some of the stuff, not we're talking about in Article 1, but they brought up some of the issues brought up in Articles 3 and 4 about annuities. It was interesting. He's at the University of Chicago. Now, I do remember that now, because I kept thinking he works at the same university that Roger Ibbotson worked at. So I kept thinking he might bring up Roger Ibbotson's name, since Roger Ibbotson wrote this article. I did as soon as I watched this class, I went and looked at this article to see if he was one of the authors, but he wasn't, the guy who taught this class this last summer. So, so this is an issue that's, you know, there are whole classes on this issue, so it's a huge issue. I do not think financial planners really use human capital as much as this article implies. So definitely make sure up front on the introduction part of your paper, make sure you clearly define what human capital is. Talk about mortality risk and how that ties to life insurance. You definitely want a phrase about life insurance being the perfect hedge for mortality risk. They mentioned that life insurance decisions and asset allocation decisions are made separately, and they want people to make these decisions together using human capital as a link. And so then they talk about, you know, their different case studies. So they went through the case studies. You do not need to talk to case studies in the articles. You need to talk the factors. But the case studies talk about the implications of the factors. And I went through a couple of those already. And then more research is needed. So there's Article 1 and 2. All right, any questions on Articles 1 and 2? Now, if you've never taken me before in a class, we're going to do a Zoom session. I'll break you into groups, and the week before the paper's due, we're actually going to grade your draft. So you have to get your paper draft in pretty good shape a week before the paper's due. So make sure you see that in the syllabus. And then I'll break us into smaller groups, and we'll do it maybe over 2 different class nights. So you only have to come once, and we'll see what works with your schedule. And we'll grade your paper, because I'm worried about people who've never had me before. They don't realize that I really want you to cover the articles in depth. I don't want just a one-page summary. I want an in-depth article. And if you see the rubric, you see that it's there. So we'll try to take that. But you don't have to wait until that Zoom session. If you want to send me your paper draft in advance, maybe you do Articles 1 and 2 and you draft that part of the paper and you want to go over that before you start Articles 3 and 4. You can do that. You can email me your paper and call me, and I'll walk you through it and use the rubric, and I'll tell you, exactly how I would have graded it. So, don't take chances if you've never had me before. Some of you had me before and you've done really well on the papers, and so you're not worried about it. But if you've never had me before, especially on this first paper, I'd recommend you talk to me in advance. All right, so no questions on papers 1 and 2. On paper 3, Article 3, the annuity puzzle, make sure you define what the annuity puzzle is. Essentially what they're saying is they're talking about immediate annuities, so be real careful with that. They're not talking about accumulation annuities. They're talking about immediate annuities. People who are retired and they want to buy an annuity that pays them an income every month for the rest of their life. The annuity puzzle is economists asking, why don't more people buy annuities? And that's exactly what that guy said that I watched his class this summer. Why don't people buy more annuities? He actually brought up the annuity puzzle. The models that are out there actually say that a large percentage of the U.S. population should be buying immediate annuities, and yet very few do. So what are the problems? Why is that? What's the issues? First of all, why do we need more annuities? Well, the baby boomers retiring. You'll see that in both articles. The industry's focused on asset accumulation. We already talked about that. Immediate annuities are not accumulation products, they are payout products. So who wants to do that? A lot of planners just assume you'll live to be 85 and you have enough money to make it 85. Well, just assume you'll die at 85 and that solves the problem. Well, people live longer than that. And then the behavioral biases, that's where you need to look at that Word document and see what they are. Make sure you cover all of the behavioral biases mentioned in the article. That's probably the single biggest thing that's counted off on the entire paper right there. And so talk about the problems. A lot of these problems are covered in both articles. So what I like about this article is they talk about the solutions. And in particular, the one I think is the most important one is this one right here. This third one. So make sure you have that one covered very well. But the solution is, let's understand these behavioral biases and make sure we market and train against those biases. So why are women more likely to buy annuities than men? how can we market annuities in a way that people are more likely to buy them? That's what their solutions are. We need to let people know that if all their money is in the market and we have a big sell-off like we did in 2008 or 2020, that can really devastate your portfolio. It's really nice to have an immediate annuity to protect you from that. But here's the key one. Let me make sure we have this one down. The reason people don't buy annuities is because the insurance industry is so focused on the accumulation of assets. They've moved to this investment terminology that they push these things as investments. And when you sell immediate annuities as an investment, people do not buy them because they say, you want me to give you $500,000 and you'll pay me $2,000 a month until I die, but if I die next week, I don't get anything. That's 100% loss. I'm not going to do that. That's the investment framework. But if you frame annuities in the consumption framework, when you tell people, we're going to set up an annuity for you so you will have the highest standard of living possible over your retirement years, people will buy annuities. So make sure you have that framing. That's one of those biases, is framing, how questions are framed. If the marketing is framed as an investment, people don't buy annuities. If it's framed as a consumption product, they will buy annuities. So that's really a key part of this article, which is the main reason I keep this article in, is to make that point, because the second article doesn't do that very well. But training, marketing, other innovative features. Now, we're going to talk about this later in class. I'm going to talk about the product I think the industry should create. This article somewhat hints at it. I don't like the particular article on this one because I just don't think it's a good article, a good product. But I'll tell you the product I really like and why I like it. I just couldn't get USAA to patent it and sell it. But it's joining the annuity with investments and actually doing a combined product, so people don't notice the annuity as much from an investment standpoint. It's all combined, but we'll get into that later in class. You won't have that when you're writing your paper, but after you've written the paper, I'll give it to you, and you'll probably have some good input. So that's that article. Highlight in your notes the behavior issues, because you'll lose a lot of points if you leave that out. And then the last article, which I really like, it's written by a guy that I've met. I've met actually three of the authors of these articles. He's a guy at he's at Wharton School of Business. Really, really well-written article. It's much better organized than some of the other articles, so it's much easier to summarize. But the first thing they talk about is what's going on in what are the issues. So there's 5 forces that are hitting Americans that is making retirement much more dangerous. Annuities are a solution. Factors that are driving people to annuitize or not to annuitize. And then they have a recommendation. They recommend that people should have at least a minimum of their portfolio annuitized. At least cover your basic expenses with an annuity, and then the rest you can leave in your portfolio. Make sure you have some provisions for healthcare issues, provisions for your heirs. So you can see there's a little overlap here even with article number 1, where they're going to talk about the taking care of beneficiaries, but you don't need to integrate this with the first 2 articles. And then reason why so few people are annuitizing. There again is the overlap with the 3rd article. All right, so this article is fairly straightforward. So there's the second article. See, it's only 1 page. Actually, on this second article, the first few paragraphs really don't have anything with what I'm interested in. So, focus on the rubric. The rubric doesn't mention anything about these first 2 paragraphs, so you can essentially ignore them. You read them, but you don't really need them. So the key here is the optionality, which they really get into in the 3rd column. Here's the pool and the stream article. If you look at this, you have a pool. So what this is a worker, and he's putting money into an investment, and it's building up. And then he's retiring, and he's on his boat with fishing. So now he's got a stream. So that's what the article means. A pool is your accumulation of assets. The stream is how you fund your retirement. And so there they have they have that discussion going through the main points of why people aren't buying annuities and what we can do about it, those biases that we have. And the last article, there's David Babel. Interesting guy. He may be retired by now because he was probably in his 50s when I met him. That was about 25 years ago. Smart guy. Wasn't the most sociable guy of all, but smart guy. I loved listening to him. Boy, he was so smart, but he wasn't real patient with people who weren't too bright. And so I was scared to ask a question in case he would embarrass me. But smart guy. I could listen to him all day. Very well written. The nice thing about this article is I highlighted it for you. You can read the whole article, definitely. And you can definitely, on this article, there's some really good charts that you can copy and bring into your article that I think are really strong. I think this is a really well written article. And if you interview in any kind of job which is financial planning related, he's going to give you some really good gee whiz numbers. Even though these articles are a little dated, I just can't find better articles. If I find one, I'll bring one in. And I forget when this article was written, but it's probably a decade or more old. Yeah, it's almost 15 years, but it's still a good. There's nothing. Unfortunately, our Congress has not fixed any of these problems, so we have the same problems he's talking about there. So it's highlighted, but you can even see he gives you really good titles. Why don't more people annuitize? So even his titles are, everything's there. They cost him much. So he's done a much better job of organizing it. So this article is much easier to summarize. I recommend you read the entire thing, and then you have my highlights afterwards to help you write your paper. So you're going to find this rubric follows very closely what I just said. Articles 1 and 2 go down to here. So they're a little bit more than half the paper. So you've got about 23% and 17% of the 40%. Articles 1 and 2 are a little bit higher percentage. Focus in on those 3.5% because they're, those combined is over 10% of the paper, and that's just 4 things. So the other thing to do is while you're reading the article and you have the rubric out, if you see something in the rubric you don't understand, email me immediately. I might actually get back to you before you finish reading the article, so you'll have that answer. So you can, while you're, depends on when you email me. But if you email me, like, what do you mean by how human capital changes over time? I don't get that. And strategy, what are you getting there? I can tell you real quickly, and then you can get back to reading the article and not waste time having to go back and reread the article because you didn't see what the question was. All right. So any questions on any of this? Are you ready to hit the ground running? Some of you are in my security analysis class, so you've got a lot of reading to do anyway. But most of you, you don't have any exams this weekend or next week. I'd say, get a lot of this knocked out this weekend. Get it going so that there's no reason to procrastinate. It's not going to help you. So get it going, start reading. You can get bonus points in here if you do any kind of online Google and find something that's more current or another interesting aspect to it. You'll have to Google very, very specifically. You can't just Google annuities because most annuities come up will be accumulation, not immediate. So, all right. Any questions?
The notes that you were going over, are those on Blackboard?
Yeah, go on the Blackboard under content, and it's got class notes.
Whenever I download those, it's the principles of investment notes.
Yeah, that's what I noticed.
Oh no, did I link the wrong one? I'll look at that. That's possible. I accidentally linked the wrong ones. All right, good point. All right, boy, I don't know how I did that. Yeah, no, you should have notes for this class, and in fact, all the YouTubes are using the class notes all the way throughout. So very closely tied to those class notes.
Great.
Anything else? You're welcome to call me anytime, email me anytime. If you call me, I'll, if I don't answer, you give me a voicemail. It's probably because I'm on the phone with somebody else, or I'm on the steepest hill on my bike or whatever, and I just got to get to the top of the hill. So I'll usually call you back pretty quickly. You don't have to call me about the class only. You're more than welcome to call me about careers. I can talk actuarial science, and not as perfectly, but I can talk actuarial science and definitely can talk finance and accounting. So if you need some input on careers, don't be like I was at your age and scared to death. Just ask questions, take advantage of professors, especially professors like I that have worked in the business, and I can give you some good feedback. So you're welcome to call me on anything related to business world, or don't call me to ask about hunting or bowling or stuff like that. I don't know anything outside of finance and actuarial science. All right, I'll let y'all go early. No, I'll stick around if anyone has questions they want after the class is over. But you're free to leave now, and I'll put this session out there on my YouTube channel. I'll email you tomorrow with links to everything you need for all the YouTubes. All right, good night.